Welcome to Sustainability Soundbites, presented by E&E Leader. Auto parts suppliers are failing before bankruptcy. The weakest link in an automotive supply chain may still be shipping parts on time. For procurement teams, the warning signs increasingly appear in cash flow, credit access, and investment decisions long before production stops. A supplier does not have to miss a shipment to become a supply chain risk. It can keep the plant running, quality metrics can remain acceptable, and deliveries can arrive on schedule, all while cash gets tighter behind the scenes. Equipment replacement gets postponed, overtime disappears, capital spending gets cut, banks become less willing to extend credit, and management starts negotiating with customers for price relief or better payment terms. By the time the supplier announces a restructuring, plant closure, or bankruptcy, the deterioration may have been underway for months. That matters in automotive manufacturing because several pressures are now converging on suppliers at once. Tariffs, high financing costs, uneven vehicle production, OEM pricing pressure, and a powertrain transition that has left some smaller suppliers with capacity tied to internal combustion programs whose long-term volumes are uncertain. Atradius warned in its July 2026 Industry Outlook that smaller Tier 3 and Tier 4 suppliers are increasingly under pressure because many lack the financial buffers necessary to absorb declining sales and tighter credit, and that banks have become more restrictive in lending to automotive suppliers, making refinancing and credit extensions more difficult. For procurement teams, that changes what supplier monitoring needs to catch. The important question is not simply which supplier is insolvent, but which supplier is moving toward a point where one more disruption could make continued performance financially difficult. A supplier can perform while its financial capacity deteriorates. There is evidence the pressure is already working its way through the sector. Automotive-related bankruptcy filings have risen since 2022, and filings through early December 2025 exceeded those of any other year in the previous decade, according to restructuring advisory firm Stout, which points to a combination of tariffs, high interest rates, lower sales, technology shifts, and rising warranty and recall expenses. But bankruptcy statistics capture the companies that have already reached a visible endpoint. The larger procurement challenge sits upstream of that event. A supplier facing financial stress generally has options before bankruptcy, including conserving cash, reducing inventory, deferring capital expenditures, renegotiating debt, seeking higher prices, closing facilities, selling assets, or restructuring operations, and those decisions can preserve the company while also changing its ability to serve customers. Suppliers themselves describe the pattern as structural rather than cyclical. Planty Moran's automotive consulting practice noted in a June 2026 analysis that affordability pressure isn't a short-term disruption, it's a structural shift, pointing to overspecification, fragmented designs, and a lack of integration across systems as sources of hidden costs that compound quietly over time. Similar to how a financially stressed counterparty can remain technically performing while accumulating conditions that make underperformance more likely later. That makes cash preservation relevant to procurement even when deliveries remain normal. Smaller suppliers have less room to absorb the next shock. The financial pressure is not distributed evenly. Atradius identifies Tier 2 through Tier 4 suppliers as carrying particularly high credit risk in parts of Europe, where smaller suppliers can have narrow margins, concentrated customer relationships, and limited access to financing, while simultaneously needing capital to adapt their businesses. Combustion-focused suppliers face an additional problem. Many have spent decades optimizing operations around components designed for internal combustion vehicles, and transitioning production toward electric or hybrid platforms can require substantial investment at precisely the point when existing businesses are under pressure. The transition has also been less predictable than suppliers expected. Slower than anticipated EV demand has forced automakers and suppliers to balance spending across EV, hybrid, and combustion platforms rather than follow a clean transition from one technology to another, contributing to concern about margin durability and earnings forecasts across the automotive supply base. That creates an uncomfortable capital decision for smaller suppliers. Invest too heavily in the next platform, and demand may arrive later than expected. Invest too little, and the supplier risks losing future business. And meanwhile, the existing operation still has to generate enough cash to finance the transition. Tariffs add pressure, even when suppliers can pass them through. Tariffs complicate the picture further. Suppliers are generally expected to seek reimbursement from automakers for tariff costs, but passing through other inflationary pressures can be more difficult when contracts do not contain clear adjustment mechanisms, and the credit consequences are already visible in individual cases. In June, S&P Global Ratings lowered its rating on U.S. automotive parts and systems supplier Tenneco to B from B, citing persistent cash flow deficits, one entry in a running tally of tariff-driven rating actions that S&P's biweekly global tariff tracker has consistently shown skewing negative, with automotive among the sectors most frequently affected. Large suppliers have more tools available to respond. Smaller suppliers may not. They can have less bargaining power with OEMs, fewer customers across which to spread costs, and more limited access to capital markets. And a tariff that eventually gets reimbursed can still create a working capital problem if the supplier has to fund the cost first. That timing difference matters when liquidity is already thin. Debt can turn an operating problem into a procurement problem. Interest expense provides another warning signal. A strategy and analysis reported by Reuters on August 7th found that interest expenses among major German automotive suppliers reached an average equivalent to 102% of operating earnings in 2025, rising for a fourth consecutive year and far exceeding levels in the rest of Europe and China. German suppliers also carried lower average equity ratios than their competitors. Those are large, publicly reporting suppliers. The problem can be harder to see farther down the chain because many Tier 3 and Tier 4 companies are privately held and provide customers considerably less information than public suppliers offer through earnings reports, cash flow statements, debt disclosures, and forward guidance, a gap in visibility that shows up across categories far beyond automotive. Industry reporting has already identified that distinction. A rapid ratings analysis cited by Automotive News found that private suppliers had a 27% higher rate of financial distress than public suppliers, and separately estimated that roughly 20% of automotive suppliers were already financially distressed before additional tariff effects were considered. The supplier that is hardest to evaluate can therefore be the one procurement most needs to understand. Procurement needs indicators that appear before the missed shipment. Traditional supplier scorecards are good at measuring performance. Financial distress requires looking for deterioration that can occur while those performance metrics still look normal, including repeated requests for price relief, shortened payment terms, delayed investments, facility consolidation, unusual management turnover, declining inventory buffers, workforce reductions, refinancing activity, or reluctance to commit capital to a customer's next program. None of those signals alone proves a supplier is approaching failure, but together they can reveal that the supplier has less capacity to absorb the next disruption, a dynamic that increasingly resembles how long-dated commitments in other sectors are now drawing the same kind of credit analyst scrutiny once reserved for traditional debt. That distinction matters because automotive supply chains remain highly interdependent. A financially weak Tier 3 supplier does not have to sell directly to an OEM to stop an assembly line. It only needs to control a component or process that cannot be replaced quickly. The visible failure comes later. The procurement risk begins when the supplier loses the financial flexibility to keep adapting, which means the most important supplier heading into the next sourcing cycle may not be the one already in restructuring. It may be the supplier that still looks fine. Interested in a soundbite sponsorship? Check out the energy category, currently sponsored by Amazon. Reach out to our team for more information. Thank you for listening.